The case for private markets and alternative investments. The business thesis of alt capital is informed by the observation that over 90% of South African retirement savings are invested in listed public markets, despite the regulatory environment and international trends suggesting a higher allocation to alternatives. Cyclically, investors are facing an uncertain economic outlook and are seeking opportunities to diversify risk and return drivers, as well as lower volatility. Structurally, national budgets are constrained with higher demands for fiscal consolidation, and thus, looking forward, this suggests increased infrastructure investment is needed from pension funds and private institutional investors. South Africa's Regulatory 28 allows pension funds 15% investment in unlisted debt, 15% in unlisted property, 10% in private equity, and up to 30% allocation in the rest of Africa, excluding SA. The actual uptake, however, has been slow. Fund asset allocations, according to Riskura, currently sit at only 2.3% due to a range of factors, chief among them being local investor knowledge and the availability of suitable fund structures. But first, to understand the case of alternatives, and in our case private markets to be exact, we must come to a common understanding of what private markets are. For alt capital partners, private markets include all alternative investments excluding hedge funds, specifically investments in these 5 areas. Unlisted real estate, such as residential developments, retail shopping centers, and industrial estates. Infrastructure. This includes renewable energy projects, water pipelines, hospitals, railway projects, toll roads, ports, and airports. Agriculture. Growing African businesses and reducing unemployment through private equity and credit. Venture capital, where our investments turn ideas into businesses that disrupt the future. Private markets form a significant part of investor portfolios at an international level. The MEIS's 2018 European Asset Allocation report that up to 45% of all European pension plans have an allocation to alternatives investments. The average size per allocation varies between 4% and 19% of total plan assets, with multi-asset strategies seeing by far the largest average allocations. This is to be expected, given that such strategies are often seen as a one-stop shop for governance and fee-constrained investors seeking a diversified and relatively liquid portfolio. In the US, the Harvard Endowment Fund allocates as much as 58% of their portfolio to alternative asset classes. They have a track record of incredible returns. Over a 20-year period, the Harvard Endowment Fund has achieved an average return of 12% per annum, compared to the benchmark return of 9.1% per annum, which might not sound as much, but over the long term, an investor in the endowment fund would have made twice the capital gains of investors who simply achieved the benchmark return. The Harvard example indicates that investing in alternative investments has a proven track record of consistently higher returns. A healthy allocation to alternatives and consistent outperformance can be closely linked. The good news is that a few South African institutional investors are conducting the necessary research to aid allocation. The Public Investment Corporation and the Eskom Pension Fund and Provident Fund, 2 of the biggest pension funds in South Africa, have launched private market incubation programs to support the transformation of South Africa's fund management industry and increase their own exposures to alternative assets. Simultaneously, investing in private markets offers rewards but can also be challenging in the following sense. Private market investments require active and not passive management. Managing the trade-offs between risk and reward is much harder than in other asset classes. Manager selection for LPs has become increasingly difficult as the number of options continue to expand. While other managers get rewarded for beating benchmark returns, alternative asset managers only get rewarded if they are profitable. This means the investment manager's interests are aligned with the investors. The manager will only make money when the investor does. The reality is, private markets are an essential part of a well-balanced portfolio. So when investing in private markets, investors are getting access to market-leading ideas and asset classes that will be and have a positive impact over the long term, an opportunity for compelling returns, and diversification away from listed asset values that rise and fall based on often very volatile stock markets.